afterwards. Okay, awesome. I'm super excited to have this conversation today. I've had a lot of buyers and friends and people reach out to me all about rates and what's happening in the market. And I'm super excited to connect you guys with Sean. He is my go-to lender that I work with for about over a year now. I think we've been working together. And he just has a wealth of information that I'm excited for him to present to you today. Sean, do you want to just share a little bit about yourself with everybody before we dive in?
Well, Morgan, first of all, thank you. You're a joy to work with, and I've been doing this now for over 32 years, and I have to tell you, you're absolutely one of my favorite people I've ever worked with.
Oh,
so
thanks. It's recorded.
Yeah, I know it's recorded. Put it down. No, I mean, you're so genuine, and you know, really care for your clients, and that's just a really fun, wonderful thing to do. And so, again, thank you again for having me part of this Instagram page. So anyway, so a little bit about me. I've been doing this for 33 years. I kind of started out doing real estate development, and then I realized I just love loans. I love working with people. I loved the pace of it, the whole thing. So, you know, for better or worse, I've seen a lot of different markets, and I've been in a lot of different markets. And you know, it's funny, this market reminds me of 2 or 3 times where, you know, again, we came off a really fast-paced market, and then it started slowing down a little bit, which is kind of where we're at. But every time it's different. You know, every time it is totally different. And what's kind of crazy right now is that, you know, the markets actually are doing, you know, pretty good, stuff like that. But the economy is still pretty strong. So usually when we slow down, the economy is actually pretty weak. Now, obviously, there's a lot of inflation, and we're going to get more into that. But yeah, I work for a great company, and we've got in-house underwriting and in-house products that we fund our own loans with. We're even doing a lot of servicing and stuff. So we're a local San Diego based company. And again, I you know, love to work with your clients to be able to help them out.
Awesome. Well, before I dive into my first question, I just want to reflect back to you the same exact thing. Working with Sean is incredible. Every client I've referred him to will go out of their way to tell me how enjoyable the experience has been. He's just a genuine, authentic person. And we do business the same way, which I think is we care about our clients first, and we're genuine, authentic, honest people. So I enjoy working with you just as much, Sean. So let's just dive right in. What is going on with rates? Like, let's just get right to the gut. And yeah, what's going on right now with rates?
Well, it's one of my favorite songs, like a Marvin Gaye song, like "What's Going On."
Totally.
It's like crazy.
Yeah, it is.
So just a little perspective of kind of like where we're at and what's happening and why that is. You know, basically, interest rates are a reflection of the economy overall, and what is happening in the economy. And really, what's happening in the economy is, if you go back kind of 10 years-ish, and so, you know, we came off of 2008, 2010, where, you know, the entire financial system around the houses, really the mortgage market, just crashed. And so what happened was the Federal Reserve and Congress and our government did everything they could to prop up the economy and get everything rolling again. And they did that by lowering interest rates, and they did that by stimulating the economy with money into the economy. So that kind of worked okay, but it was like this really slow recovery. I don't know if you remember, it just took forever, and it was like, oh my gosh, it was during the Obama years, right?
Yeah.
And so interest rates during that time were kind of like this, and you know, by 2014 or so, the real estate market started just to take off again. You know, the stimulus that was there, we got through all that, and really what happened was there was a ton of inventory, right? So people bought a lot of stuff. So kind of fast forward where we are was really by 2018-19, it was like we're there. We've actually, our economy's up and going good, and real estate prices are back, and everything's going good. So the Federal Reserve started to raise interest rates in 18 and 19. We got up to, we were doing loans. Actually, I was, you know, almost 5% at the end of 2019.
I remember that too.
Yeah, and it kind of, you know, everyone was like, oh my gosh, you know, it was at 3.5, 3.75, 4 for a long time, and then it, you know, popped up. Okay, big event, COVID. COVID hits, entire world shuts down, right? 20 million Americans lose their job, right, out of the workforce. And there's a real panic at the Federal Reserve level and at the White House and the Congress of like, are we going to get through this type of thing without major disruption? So they did some really unprecedented stuff that hasn't really been done, I don't think, in 50, 60 years, which is they, in essence, dropped borrowing costs to zero and pushed $6 trillion into the economy.
Yeah.
So they flooded, not only did they drop rates, borrowing costs, but they flooded basically the economy with money. And at the same time, the Federal Reserve got in and started buying mortgage-backed securities, as well as also T-bills. So what did that do? It artificially dropped interest rates even lower. And the reason for that was they were basically trying to get people to refi and borrow more money out of their houses to be able then to stimulate the economy. So really unprecedented, just a once in a total generational thing, occurred. Okay, so now fast forward 2 years later, right? We all survived COVID and we're here to tell the tale. And basically they're like, okay, we got this thing called inflation. It's a problem. And so
came in a
little hot here. So really the question is what is inflation? So a very fundamental, point. Inflation is too many dollars chasing too few goods and services. So when you have that, it's the classic supply and demand. If there's only a few, let's make it easy. If there's only a few $1 million houses in La Jolla, but a lot of people want to buy them, the price is going to go up. And you can say the same thing about whether it's, furniture, or if you can say the same thing, it's about airlines going to a trip somewhere. If it's about a supply and demand thing. So the issue is, we had this disruption in supply goods, and at the same time, we had a ton of money in people's pockets. Okay. And that's both mainly the consumer, but also, companies also had a lot of money. So anyway, that's where we are. And so now the Federal Reserve is saying, okay, how are we going to get this back in balance? And so what they're doing is they're aggressively raising interest rates. And they're also have stopped buying mortgage-backed securities, and they've stopped buying treasury bills. And so now we're seeing the rates on that going back to what really market is. So that's where we are. And the question is, what do I think maybe going forward a little bit? Going forward, I think we've seen a big bite out of the interest rate apple right now, as far as mortgage rates go. Can I see them go higher in the future? Possibly. And we get a little bit more into that maybe a little later in the call.
Yeah, that's what a great kickoff. Like, I feel like even just the description you gave of the inflation was like, I wish I had you as my economy teacher in college. That was really helpful. I think one key element that you and I have kind of been discussing offline, like on the phone, is that we can't necessarily look at the 275 30-year fixed as a baseline, right? That was kind of this anomaly to adjust for kind of what was going on in our world at the time. And so I think what I'm hearing from my buyers, my clients, people who are potentially looking to buy in the future, is they're really concerned. They're like, oh, well, I'm going to wait for rates to go back down. And it's using the 2.75, I'm just throwing that one out there as a reference point. I think you're going to set yourself up for disappointment if you're a buyer, because it's unlikely we'll see that in the near future. Would you agree with that?
Yeah, I'd say so. I think it goes back to, if you look at the last 20 years, which is a really good interest rate environment as far as low interest rates go, the average 30-year mortgage is 4.75. Okay. And if you click that back 30 years, it's 6.75. So, I'd say for most of my career, we've seen interest rates around 4%, give or take, a half a point, obviously some anomalies along in there, but to see long-term 30-year mortgages at 2.75, 2.5, I think I did 2 loans like that. Most of them were 2.75 to 3, kind of, we did this big refi push. So I think that, again, as you said, that's just not realistic. Right. That's kind of like saying, you bought Bitcoin when it was $100 a share, or you were the second investor in Microsoft or Google or something, right? Yeah, right. Sure. probably not going to happen again real time soon. So.
Right. Right. Awesome. Thanks for that. And then just one little key point I was going to make too is like just the real estate market in general. We've been seeing increase in the market. We've had seller's market, if you will, for the past 12, almost 13 years, and a normal sales cycle is like 7 to 10 max.
Right.
So we've been well aware that this is on the horizon. And now back in 2020, 2021, we just hit our tipping point. We were just at maxed out. And like you were saying, how there were all these buyers, there was limited supply. We were simply, I remember one deal where the property was 1.3. We put in an offer at 1.4 and it closed at 1.75. So just to give people an idea, if they weren't active in the market, just what that was like. 20 offers on the table in 3 days, no contingencies, like giving your firstborn child, and it still wasn't enough. And so this normalization, I think, is just healthy and just a natural part of the evolving process.
Are you, Morgan, are you seeing some, slowdown as far as this multiple offer or overbidding going on? Is that kind of slowing down the market?
Yeah, I would say it's really dependent on the product, meaning like if it's your standard like flat backyard, 3+ bedrooms, 2.5 bath, nice floor plan, good location, there's definitely still demand there because we're still seeing a limited supply. And then what's also happening is that listing agents are comping properties, as they should, on recent sales. But there's so much that has happened in the past 2 weeks even that those prices are no longer relevant. And so I was telling Sean as well earlier is I meet with like 100 brokers every single week. And this week was the first week I heard 7 price reductions or price adjustments, if you will, on properties, because they're recognizing, okay, we got to adjust here if rates are going to be there. So yeah, we're definitely seeing shifts in the market. However, like under that 2 million, and especially in the La Jolla market, there's still significant demand because there's just such limited supply.
Yeah. And I think that's the key. Again, it kind of goes back to what we were talking about, just pure economics of supply and demand is, sure in Phoenix or in Vegas where there's still building houses left and right. Yeah, you could see this interest rate directly impact the housing prices immediately, almost one for one. But out in our market, in San Diego and some of these in Southern California, it's literally, there's still not a ton of supply out there. And so even though there is an impact financially, again, there's still a ton of demand out there. Yes. That's going to moderate. And that's definitely going to moderate, but they got to build more houses, really is the solution.
Totally. I mean, there's a definite housing crisis. That's a whole other conversation. I feel like, especially in our market, because even back when there was the crash in 2008, if you look at the numbers historically for specifically San Diego versus the rest of the nation, the impact was much less here just because it's a different market. There's a different buyer here. 30% of purchases in the La Jolla market are cash. So that has an impact as well. But yeah, so let's continuing on this kind of rate story. I know you had some actual numbers to share with us to kind of paint the picture for the buyer.
Yeah, one thing I'd like to talk about just really quickly, and it always confuses me too, but it's the whole thing about the Federal Reserve met and raised rates. So what I wanted to show you was what that actually is and how it's not necessarily tied directly to mortgage rates.
Super important.
When the Federal Reserve, so maybe I'll share a screen here if I can. Let me jump in here. We had it up, right? So it should work.
Yeah. And while you're doing that, because I've heard people, and I've even thought they raised rates 3/4 of a point, like what does that actually mean? People take their loan, they add the point to it, they just directly correlate that, and it's not always the case, right?
Right, exactly. Let's see if I can jump in here.
Cool, perfect.
I'll jump in, and I'm going to jump into a little different deal here. I think we got that. So when the Federal Reserve meets, they're talking about this thing called what they call the federal funds rate. And that is the interest rate that member banks, so think about it like Chase and Citibank, charge each other for a overnight, or call it a one-day loan on a loan so that they can balance up their books. So it's not, the Federal Reserve only really controls a couple of these short-term rates. Now, obviously, that then ripples into the economy, but the mortgage rates are more tied to what they call the bond market, which is literally investors all over the world looking at everything and then setting the rates by buying these mortgage-backed securities on the market. So again, the federal funds rate, and what you hear when the Fed moves something, it's not a direct correlation like, oh my gosh, the federal funds rate, the Federal Reserve met 2 weeks ago and raised their federal funds rate by 0.75%. So that does not mean that mortgage rates go 0.75. Actually, when they did that 2 weeks ago, interest rates on mortgages actually went down a little bit. And the reason for that was the Fed had been saying all along they're going to raise rates, their short-term rates, by 0.5 point every meeting for the next 3 or 4 meetings. They then revised and said, we think that inflation is still out of control. We're going to go 0.75. So the mortgage markets guys went, oh, well, that's good, because that means they're going to really squash this inflation thing, which hurts us. So it's almost, what you really have to do is you have to look at, you can look at, you can go online, there's 30-year mortgage and stuff you can look up, or you can call me. But here's a little graph, and it just shows you where, this is going way back to the 70s, where the federal funds rates have been. And you can see there was this in 2010, they stayed really low. And then again here in COVID, they went really low. But you can see where they're going. They're only at right now, I think about 1.75, well, it says 0.83, but it's really, I think, 1.25. And then they were up just to 2.4 just not too long ago. So again, the federal funds rate, not a direct correlation, but it is showing you that the Federal Reserve will use monetary policy to try to stimulate the economy. So I want to jump over just to the 30-year mortgage too, just really quickly.
Oh gosh, look at the 1980s. Agents talk to me about that all the time.
Yeah, here we go. Here we go.
18%.
Yeah, it's 19%. Let's see, when did I buy my first house? It was like there. It was 15. I remember my first loan was an adjustable. It started at 11%.
Oh my gosh, that's gnarly.
But yeah, you can kind of see that again, there's these little troughs and valleys, like rates go up and then they go down, then they pop up again, they drop down. So that's kind of this rhythm that I think you were talking about, which is, sorry about that, which is, there's a 7-year cycle. Usually, I think 7 to 10, in real estate, up and down. And you can see, even when the trend's been down pretty much for, the last 20 years in interest rates, there's all these little like troughs, and then it goes up to the top, and then it comes down, it goes up. And the thing to think about that in mortgages, and we talked about that as some of the ARM products now are becoming more in vogue, is that most people go with a 30-year fixed mortgage, but they don't use it because like 75% of people will either refi or sell their house in the first 7 or 8 years, or in every 7 or 8 years. So one play right now, when interest rates are a little bit higher, is to say, hey, maybe I don't need the 30 right now. Maybe I can go with like a 7-year, and I can get a lower interest rate, lower payment. And then at some point when we see one of these little dips again, then you come back in and then if you want to do the 30-year refi, or do another 7-year, refi. So there's other products that you can jump into here.
I think that's really important to see, because especially like millennials are saying, like, you're exactly right. Like, no one's living in their house for 30 years anymore. No. It's just not a thing. And so I think to recognizing what the sales cycle is, it obviously is going to correlate with buyers and sellers. So if someone's staying in their property for 7 to 10 years, like, that is the trajectory of the market. So I think it's cool that you noted too, it's just like, I don't think, unless you've truly met with a lender, or you've bought a house before, or you've met with someone like Sean who can share kind of the extensive background of what mortgage options are, I think a lot of people don't even recognize that those are products available to them.
Yeah, there's a lot. And there'll be more kind of products coming out. I know, anyway, the industry, kind of went all in on the 30-year fix because it was so low, but now as rates are going a little higher, some of these other products are going to come out, and the mortgage market's pretty innovative as far as what they do. I don't know if we're going to go back to the NEGAM or the stated income loans, but I do think, you know, the different product options are going to come back.
Yeah, which is great to give people just awareness of what's available to them.
Yes,
you know.
exactly.
Cool. So now what's next? Like what?
Well,
yeah.
But maybe that we can talk about a little bit, and maybe you said like the number one thing. What did you say? The number one thing that people are saying right now about, you know, buying right now or buying in the future?
Oh yeah, I mean, I have a lot of buyers or people who are planning to buy maybe in the next year or two who are like, you know, I think I'm just going to wait for interest rates to go down. And while we don't have a crystal ball, so we don't truly know exactly what's going to happen, I'm a little apprehensive for them to do that, especially if they're renting, because those funds are allocating to nowhere. And we don't foresee rates going down, especially to that 2.75 anytime soon. So and we talked about this too before the call even, is just, I think, is it the right time to buy, right? Is like kind of the question that everybody has. And we have a few answers for that, I think.
Yeah, let me jump in again here, and let's I'm gonna go to the share screen. I'm gonna show you a little, it's a software package that we have that's called Mortgage Coach, and it kind of addresses some of these scenarios, and it kind of puts real kind of numbers together. So what we did is beforehand, Morgan and I were talking about this, and we did kind of a scenario, which is, you know, I guess in San Diego County, I guess the average sales house price is $1 million. You were telling me that's amazing.
Yeah.
I didn't know it gotten up that high, but
yeah.
So we did a scenario. We did 3 scenarios, but we did a scenario. The base scenario is $1 million purchase with 20% down, and I showed a 30-year fixed rate at 3.5%, and then I jumped it up here at same scenario but higher interest rate, 5.5%. And then we did it like at $850,000 at 5.5%. Now interest rates right now on the jumbo product are 5.25%, 5 3/8, 5.5%. So that's kind of where it is right now. The 7/1 product is more like 4.75, 4.875. So that gives you kind of an idea. But I think what we wanted to talk about here was, okay, what does that payment look like?
Right.
So if you were lucky enough to buy a house when the rates are super low, your all-in principal, interest, tax, and insurance payment was about $47.84 a month. Okay. Today, that same house, same price, everything is $1,000 more with the higher interest rate. It's $5,733.
Wow.
Now, what would it take to get your payment kind of back to that same, you know, $4,800? Well, really, you're going to have to drop the price down to about $850. Okay,
Right.
That's going just 30-year fixed. Obviously, we can do some other products and stuff. But let's dig a little deeper and kind of really look what's really going on here. So one thing that we look about is like, okay, what's your current situation?
Right.
And we look at like, okay, you're currently paying rent. We're just using $3,800. Obviously, everyone's situation is different. But if you're in a single family house here in San Diego, that's probably where you're at on the low end, right? I mean,
right.
You go a lot higher than that.
Yep.
So what this net monthly payment is, and I can jump in a little bit closer here, is basically what they're talking about is, let's jump out of that. But what they're talking about is part of your mortgage payment is principal, and it's about $1,000 a month in principal that you're paying. So if I back out the principal, which is really just savings, and look at really what you're paying for that owning house versus renting house, look at that. I mean, you're at about $3,800. Now, obviously, it was cheaper, 2 years ago.
Right.
But right now, you're still at a rent equivalent of about $3,800. And again, that payment's going to pretty much stay the same, while as the rents are going to go up.
Right. Right.
So
we're anticipating rents. We're anticipating rents to go up just because of the shift in people saying what I just said. That maybe I'm going to wait to buy and I'm going to rent now. So the demand there is going to increase, and there's still limited supply on rentals.
Exactly. And then again, this chart talks a little bit again about how much rent you're going to pay and then how much principal down. This is a really interesting chart. This is called a net worth analysis here. I'm going to zoom it up a little bit. But really what this is, it says, okay, let's take the long view here. Let's take the long view versus being a long-term renter versus being a homeowner. And a couple assumptions. We used a rental increase of about 5%. We used property appreciation of 3.5%, which is very conservative, and a tax bracket of about 28%. So if you look at that over that 15 years, you're going to pay about $1 million in actual rent. Okay. At the same given time, your total payment on the new loan amount is going to be about the same amount. It's going to be about $1 million. Okay.
Yeah.
You're like, okay, I'm going to pay the same amount. But wait a second, 15 years from now, you own a house. Down here, you're still renting.
Right.
So, yeah, exactly. So if I look and say, okay, what's my value of that property going to be at 3.5% appreciation? It's going to be $1.6 million, $1.7 million. And what's my loan balance going to be? Because I'm paying down that principal every month. It'll be about 500. So now you have a net worth of $1.1 million versus nothing over here.
Yeah, that's really, when you can see the numbers side by side like that, I think it just makes it pretty obvious. But I think too, something that we touched on was like, it's really dependent on your personal circumstances. Now, is now the time to be buying an investment property and selling in 2 years? Probably not. But if you have the financial means to purchase, like regardless of how rates have shifted, it's still a good time to buy if you're planning to stay in that home for the long haul.
And that's it. I mean, we talked about this a lot, which is matching people's particular circumstances with the right financial move.
Right.
And, I think, some people are super fluid, right? Their works now, they can work remotely and everything like that. And they may have lived in San Diego, or they may be going, yeah, we could move though to Tennessee, or we could move to, so if you're super fluid, yeah, maybe not. But if you're ready, if you're at that point in your life where it's like, okay, I'm sick and tired of getting, bounced around by my landlord. I'm sick and tired of, not being able to customize my house the way I want it.
Yeah.
I've got money and I can invest it in the market, or I can invest in a house, or make a house my own. If you're kind of at that point, I would argue that that getting in the market right now and looking could be good, because potentially there could be more inventory coming out on the market. Some people, the sellers on the flip side of this, look like, oh, maybe values are coming down, so maybe I need to get the market, the property out there.
Right.
And there could be less buyers out there looking, so you have less competition.
Right.
The other thing I always tell, and I know, Morgan, you're great at this too, is I always tell my clients is, let's get you the very best loan possible. Let's get you pre-qualified and get you ready to jump into that market. But I said, the mortgage piece is just a piece. I said, the bigger piece is the real estate. It's finding the right piece of property that you're going to be happy in, and that you could see yourself there for some time.
Right.
So it doesn't have to be your forever house, but it's a house. It's a house that you want to feel good when you come to your home and where you live and your lifestyle and that whole thing like that. So
totally.
The focus really should be on the real estate. And again, there could be some good opportunities coming up.
Right. And then at the end of the day too, is like, I think in the way in which you work with your clients too, is just being super transparent and open of like, okay, just the model you just showed us. Because frankly, as you did in the beginning, the $1 million property, in order to adjust to match the price point of the prior rates, has to drop down to $850. And while we haven't seen it necessarily impacted to that level yet on those price points, we are anticipating as agents, we have the conversations all the time that the list price of properties are going to have to adjust to reflect this, right? So there's going to be this like sweet spot almost where once the sales prices start to level set a little bit and interest rates still aren't super high, if you have the means and you're, like you said, you're kind of planning on settling down, you have the trajectory, at least 5 to 7 years is what I tell my clients, that you're going to be staying in the house. then certainly like the whole, like, is it the right time to buy is, I would say a for sure yes. But again, it's always based off your personal circumstances, which is why like Sean and I do buyers consultations. I know you do consultations with clients as well. See what their portfolio looks like, what their long-term plan looks like to identify, is it the right time for you? And that's really what this is all about. Mm-hmm.
Yeah, and that's it. And it's really about, kind of customing, the individual's current needs
Right.
to what's going on, both in the market as well as the mortgage products go.
Yeah.
Look, it's a big number, right? I mean, it's a big step for anybody, and
Yes.
it's always more. I think it's one of those deals where you want, it's emotional as well as also financial, because it's something
Absolutely.
that you're living in and you're paying every month, and it's a fairly big number.
And it's most likely the largest purchase that people have made in their lives. And you're like raising your families there. You're creating moments, memories,
Yeah.
experiences, right? Yeah.
Absolutely. So you want to do it right,
Yeah.
and that's where I think, working with Morgan, and, I'd like to think we're pretty good too, is that, we're going to help you make the right decisions. I mean, it's, we're not here to sell you a house or sell you a mortgage. I mean, I think it's about, consulting with folks and being advisors to folks and helping them, make some right decisions. And, when you get into a transaction, you need somebody like Morgan that's going to at some point tell you, hey, maybe we have to walk away from this deal. You're getting too emotional, or, you're getting a little too emotional. This is actually a good deal. Let's get this done.
Yeah, totally.
It works both ways.
Part informing client, and then in part therapy session, which is why also my coaching license, which helped tremendously in my career, I'll tell you.
Yeah.
But I think the thing too is the people I attract are very much like me. Yeah. I would feel the same way kind of going through this process. So I think we know how to speak to those people. But at the end of the day, kind of wrapping this all up is just like, we want to inform you with the right tools, the right information, maybe provide recommendations. But at the end of the day, we want you to feel strength in your decisions because you have the right information.
Yep.
Like Sean said, it's not about, I can't convince you to buy a house. It's definitely not my job, and I don't want it to be. So, yep.
Yeah.
Awesome. Well, thank you. Did you have anything else as we wrap it up, or?
Well, again, it's just so much fun. I think technology is great. I think we're able to, I think, really assist our clients in such a better, higher level now. And it's crazy. I look at the last couple of years, and I think a lot of, there's obviously been a lot of disruption, but there's a lot of good stuff. I mean, everyone's Zooming now, and more people getting connected. And we're using technology to be successful, and I think it's going to just continue to be like that. And it's we're in a great place in the history of the world, big picture, and it's just every day it's just great to be here and work with Morgan.
Look at your positive vibes. I love it.
I'm loving
all about it.
Bring it on.
And so for anybody after watching this video, if you have any interest in connecting with me or connecting with Sean, I will have our contact information, so you can easily do that. Thank you so much, Sean, for taking the time out of your super busy schedule. I know you're very busy to present this information so that everybody can feel more informed about what's to come.
Awesome.
All right. Thank you so much.
Bye all.